Hi guys, welcome back. Today we are going to talk about price risk and reinvestment risk. Debt instruments, especially bonds, are said to be safer than equity instruments such as stocks. We all know that. However, it doesn't mean that the investors are not going to face risk when they are going to hold a bond. What are the risks that an investors would face when holding these debt instruments? One of them is price or interest rate risk. Price or interest rate risk is the risk that a rise in market interest rates will decrease the value of the bond. To illustrate how this happens, let us go to the following sample case. Sample case number 1. Consider the following bonds issued by ABC Corporation. We have bond A and bond B, both with a par value of 1,000 pesos, a coupon rate equal to the market interest of 10%. The difference, however, lies in the years to maturity. Bond A has a remaining 1 year to maturity, while bond B has 3 years to maturity. Let us calculate the value of both bonds now, assuming today is year 0. So as you can remember from the last video, the value of an asset is the present value of the future cash flows it is expected to generate. The reason why you want to buy an asset is due to the fact that you have an anticipated future cash flow that will flow from this asset. And you have to take the present value of such to arrive at the value that you are willing to pay for the asset. In the case of bonds, this will be in the form of coupon payments and the par value to be received in the future. Let's go to bond A. So bond A has a remaining 1 year to maturity. The coupon payment is 1,000 times 10%. That would be 100. Then after that, the par value would be returned, 1,000 pesos. So let us take the present value factor for 10%. The PV factor for 10% is 0.9091 for 1 year. So that would give us the present value of coupon payments 90.91. The present value of the par value at 909.09. This will give us 1,000 pesos as the value of bond A. Now let's go to bond B. Bond B has 3 years remaining to maturity. Again, the coupon payment would be 1,000 times 10%. That is also 100. But this time, it will be generated every year for the next 3 years. At the end of 3 years, the par value of 1,000 pesos will be returned to the investor. And hence, we can now calculate the present value of these cash flows. At 10%, the PV factor lump sum, 0.7513. PV factor annuity, that's 2.4869. This will give us a present value of the coupon payments, 2.4869 times 100, that's 248.69. The present value of the par value, 0.7513 times 1,000, that's 751.30. At the end of the day, you will have approximately 1,000 pesos as the value of the bond. At this point, I want you to appreciate the fact that when the coupon rate is identical to the market interest rate, there's really nothing to calculate. We do not really need to calculate the bond's value. It will automatically be equal to the par value. So it is just right that this is 1,000 pesos. We are requiring a rate of return of 10%. The bonds are giving us 10%. So at the end of the day, we would be willing to pay an amount equal to the par value for such a bond. Now, here comes interest rate risk or price risk. Follow-up question, let us calculate their values if the market rate went up to 15% now. Again, now is year 0. If we're going to look at it for bond A, given the timeline, in a span of 1 year, 100 will be received as coupon. That's 10% of 1,000 and 1,000 par value. Taking the present value of such, using the new required rate of return of 15%, we are going to have a PV factor of 0.8696 in a span of 1 year. So you would have 100 times 0.8696, that's 86.96. 1,000 times 0.8696, 869.60. This would give us a bond value of 956.56. What does this mean? Well, an increase in the market interest rates would pull down the value of the bond. What's the reason for this? Well, this time, we are not contented in receiving only 10% rate of return, which the coupon gives us. As a result, we would be willing to buy the bond only. We're going to pay an amount below the par value. Now, let us look at how this would affect bond B. Bond B has 3 years remaining to maturity. So the coupon payments would be 1,000 times 10%, 100 each year. And at the end of 3 years, the investor will receive the 1,000 peso par value. So for 3 years, a 15% rate of return will give us a PV lump sum of 0.6575 and a PV annuity of 2.2832. So 100, the coupon amount, times 2.2832, that's 228.32. Par value of 1,000 times 0.6575, that would give us 657.50. So the value of bond B is 885.82. What have you observed in this calculation that we have made? Under both bond A and bond B, we can see that the value went down as a result of the rising market interest rates. Market rates went up from 10 to 15%. The value of the bond went down. Again, this is expected. However, you are to notice that bond B is more affected than bond A. Why is this the case? Well, it has something to do with the maturity of bond B. Since bond B takes a longer time to mature, it will be affected more than bond A when it comes to rising interest rates. This is what we call the interest rate or price risk. Again, the interest rate or price risk is the risk that a rise in market interest rates will decrease the value of the bond. The longer the maturity of the bond, the more it is exposed to price risk or interest rate risk. Now, a more technical way of measuring price risk is what we call the Macaulay duration. Now, let us go to the second type of risk for this lecture, the reinvestment rate risk. The reinvestment rate risk is the risk that a decline in market interest rates will decrease the income from a bond portfolio. To demonstrate, let us refer back to sample case number 1. Again, you can see the following figures. The key difference between bond A and bond B is that bond A has 1 year remaining to maturity, while bond B has 3 years remaining to maturity. So for both bond A and bond B, let us calculate the interest income after 1 year. That is, we are looking for the interest income in year 1. So for both bond A and bond B, the coupon rate, which is equal to the required rate of return, is 10%. So 1,000 times 10%, that's 100 pesos to be received by the investor in bond A. And another 100 pesos calculated in the same way for the investor of bond B. At this point, they would have the same cash inflow, 100 pesos in a span of 1 year. Now, let us continue with this story. For a follow-up, let's calculate the interest income of both bonds after another 1 year, that's already year 2, if the market rate went down to 5%. Note that at this point, bond A has already matured. As a result, if the bondholder wants to invest again in bond A, the terms should again be renegotiated. But because the market rate went down by 5% to only 5%, so the new interest rate that would be agreed upon will now be only 5%. So 1,000 pesos times 5%, the interest income in the form of cash inflow after 1 year will only be 50 pesos for the holder of bond A. But as for bond B, since it is still going to mature in 2 more years, that is in year 3, the 10% original coupon will still be the rate applicable. So you would have 1,000 times 10%. That would give you 100 pesos. At this point, you would notice this time that the bond with a shorter maturity is at a disadvantage. So we can say that reinvestment risk affects bonds with a shorter maturity more. Okay? So this is what reinvestment risk is all about. This is the risk that a decline in market interest rates will decrease the income from a bond portfolio. Reinvestment risk affects bonds with a shorter maturity more. So that would be it for this lecture. Like, share, and subscribe.